Welcome to this weekly update. I'm Julia Lee, an equity strategist at Bell Direct, and it's been a great start to the new financial year with the Australian share market trading at the highest level that we've seen since November 2007. But let's kick off with the miners and Citi asking the question, is this time different? One of the most pressing questions for investors is what to do with the miners here after the run that they've had. If we have a look at historically, the peak in earnings for the mining space has been when the sector relative PE ratio has contracted to an average of 0.82 times the Australian market. This is on a forward basis, and the mining sector currently sits at 0.77 times, so not too far away from historical peaks. So far, this cycle looks a lot like previous cycles. So, what's different this time? Well, the miners have rapidly sorted out their balance sheets and they've retained investment decision. The mantra has really been value over volume. And as a result, cash flow generation over the next 12 to 18 months is so strong that valuation metrics are far from stretched. Citi says the best way to play it is Rio Tinto, because of its scope for large-scale capital return. Sticking with the miners and looking at values, and values has been having a look at its gold price, copper price, nickel, as well as zinc prices. One of the key considerations has been the US-China trade war, the tensions there, and tariffs out elsewhere. Also the deterioration that we've seen in economic conditions, especially in Europe. They've revised aluminium, alumina and nickel downwards. Only copper has been lifted largely on supply factors, while zinc has remained unchanged. It likes gold, and in terms of larger caps, their preference is for Evolution Mining. In copper, they like Oz Minerals, which has a balance of portfolio quality, opportunity and valuation. It, however, is also trading at a premium to value. And nickel, they like Western Areas, WSA, on valuation and mine life basis. Moving on from the miners to the healthcare space, and we know that the Aussie dollar has been trading lower and many healthcare stocks have an exposure to that lower Aussie dollar. So Ords has revised its Aussie dollar forecast against the US currency from 71 cents to 70 cents. This impacts the valuations of companies reporting in US dollars. Having a look at some of their ratings across this space, they have a hold on Ansell, a hold on ResMed, and an accumulate rating on CSL. From healthcare to real estate, and looking at UBS, where they don't see, firstly, a break in the retail off-trade as the queue to sell shopping malls lengthens and as operating income outpaces slow retail sales. Number two, they see a risk in residential activity stabilizing. They see that the risk is that it does not recover and that residential real estate investment trusts disappoint at the next result. And thirdly, while office and industrial have performed well, they think that the momentum should continue. In terms of a preference for property stocks, they prefer Goodman Group, GPT, as well as Lendlease. They least prefer Essentia Vicinity as well as Stockland, and here you can see the 2-year forecast together with the expected yields across the property space. And finally, ending off with Bell Potter. There's been a huge amount of picks for the new financial year, but this time we'll focus in on technology. Bell Potter saying that they continue to be positive on technology in Australia, especially in an environment where low interest rates and low growth is occurring. There's a number of good quality stocks with reasonable to strong growth outlooks in the tech space. Their top three, number one is Integrated Research, IRI. This is a software company with one key product, which is Prognosis. It monitors customers' communications infrastructure or payment systems. They are forecasting a record performance in FY19, and this should drive a further re-rating of the stock. Bell Potter has a target price of $3.50. The stock price is currently at $3.30. Bell Potter also liking Technology One, TNE. This is end-to-end enterprise software. The shares did sell off on a weaker than expected first half result, but Bell Potter sees that as a timing issue. They say the catalyst will be a strong second half result. They have a target price of $9 on the stock. The stock is currently trading at $8.16. And finally, Catapult. This is Elite Athlete wearing tracking and analytics. They have a target price of $1.50 on this stock, and the stock price is currently at $1.11. Well, it's been a fantastic start to the new financial year. We've seen the Reserve Bank once again cutting rates in Australia. It's the first back-to-back rate decrease that we've seen in Australia since 2012. And that means some of those high-yielding defensives have been performing well. We've seen a good performance for the likes of Telstra, the property sector, utilities, and some of the bond proxies like Sydney Airports, Transurban, and Auckland Airports. But we have also seen growth continuing to outperform. So at the moment, we are seeing the market doing well, both on the growth end as well as on the defensive end. I'm Julia Lee, an equity strategist for Bell Direct. Hope to see you next week.